Welcome to the Deep Dive, where we cut through the noise to give you the signal you need to stay well-informed. Today, we're doing a deep dive into the fiscal Q3 2025 earnings call for Tilly's, ticker TLYS.
And this call was easily one of the most surprising of the week. Tilly's has been, well, let's just say, viewed with deep pessimism for a while now.
A long string of underperformance, right?
Exactly.
Yeah.
But these Q3 numbers, they provided some really strong, tangible evidence that management's turnaround plan is, actually starting to work. This feels like an inflection point.
And the market reaction proves it. So our mission today is to unpack the financial print, dissect the operational changes that drove this, and look at the guidance that has investors suddenly changing their tune.
Let's start with the snapshot, because the headline results were, frankly, shocking, especially on the bottom line. The company reported a net loss per share of just -5 cents.
Okay, hold on. Let's just sit with that. The Zacks consensus was a loss of 30 cents, so that's a 25-cent beat. For a retailer that's been bleeding money, that kind of surprise means something fundamental has changed.
It does. It shows you just how catastrophically low expectations had gotten. And while the profit beat was huge, the top-line numbers gave it that operational validation. Total revenue, $139.6 million.
Just a little ahead of consensus, but still down year over year.
Still down 2.7%, yes. But the metric that really validates the entire turnaround narrative isn't the total revenue.
It's the comps, comparable net sales.
Absolutely. Total comparable net sales were positive 2%. And you have to go all the way back to Q4 of fiscal 2021 to find the last time they posted a positive comp quarter.
And it wasn't just a fluke month either. Management said comps were positive in each month of the quarter. That shows sustained momentum.
That's the key. That sustained positive comp plus the massive profitability beat, that's why the stock just exploded after the announcement. Surged on huge volume.
Okay, so let's unpack that operational story. Because a 2% comp doesn't normally cause a 40% stock move. It's about the quality of those sales, which takes us right to the margins.
And this is where it gets fascinating. Gross margin expanded by a staggering 460 basis points year over year to 30.5% of sales.
460 basis points. I mean, for a specialty apparel retailer, that is not a small improvement. That's a structural shift. How do they even do that?
It's highly unusual. It tells you all that pain they took clearing out old inventory is finally paying off. Product margins specifically improved by 390 basis points.
How?
It's two things working together. Higher initial markups, so they're pricing things right from the start, and critically, much lower markdowns. And that's a direct result of running with leaner, fresher inventory.
And you can see that on the balance sheet, which is where you always have to look to confirm these stories.
Exactly.
Yeah.
Net inventories were down 12.8% year over year. By just carrying less stuff, they forced more full price sales and cut way back on the heavy discounting that just crushed them last year.
But the channel performance tells a more nuanced story. Physical stores were strong, comps up 5.3%, but e-commerce?
E-commerce comps were -9% year over year, a huge dip.
Which, on the surface, looks terrible.
It does. And management was right on top of it. They said the decline online was a deliberate strategic choice. The drop was mainly because of a 51% reduction in clearance sales online compared to last year.
Now, you have to be a little skeptical there. I mean, isn't it a bit convenient to just say, oh, our e-com is down because we're strategically shedding bad sales? How do we know it isn't just a loss of market share?
That's the critical question. And the proof is in the gross margin. If they lost share and still had a discount, you wouldn't see a 460 basis point expansion. They consciously sacrificed that top-line revenue online to prioritize full-price sales across the board. It's a choice.
Yeah.
Margin health over vanity revenue.
So they're taking a hit now for what they hope is healthier growth later.
Precisely. And while they did that, they also kept a tight lid on operating expenses. SG&A was down $6.7 million year over year.
I saw that. About $1.5 million from store payroll, another $1.5 million from e-com fulfillment.
Yeah.
This is real discipline. That's how the operating loss shrank from over $14 million last year to under $2 million this quarter. That's pure execution.
It's the whole package. It's not just cutting costs, it's making every sale more profitable.
So beyond just cutting, what are the forward-looking growth levers? You can only shrink for so long before you need a real growth story.
All right. First big lever is proprietary brands. Management wants to get those brands up to about 40% of sales on an annualized basis. That's up from 37% year to date.
Which is huge. That's a move toward being a vertical retailer, where you control everything from design to the shelf. It's about exclusivity, control, and better margins.
And that feeds right into the second lever, technology. They launched an AI price optimization tool back in September.
So what does that actually mean? Is it a defensive tool to stop markdowns or an offensive one to get a higher price?
It's both, really. The AI helps them improve average unit retail, so it stops them from marking down hot items too early, but it also helps them price slower items to move before they become a real problem.
And there's more tech coming.
Yeah. For fiscal 2026, they're planning to roll out RFID in stores for much better inventory accuracy and an AI-driven tool for replenishment and allocation.
RFID is a game changer for accuracy. And importantly, they're doing this without a massive CapEx spend. It's all about efficiency.
And finally, they're leaning into social commerce. They said their TikTok shop, which launched in March, is seeing rapid growth. They're using brand ambassadors. It's not just awareness, it's a direct sales channel.
So if we connect all this, the market isn't just reacting to a good Q3, it's reacting to the guidance, which suggests this is sustainable.
Well, not just sustainable, it seems to be accelerating. They reported that Q4 quarter-to-date comps through December 2nd were up 6.7%.
Wow. So it's not just holding, it's actually picking up steam.
And that's baked into their Q4 guidance. They're guiding for total sales of 146 to 151 million, which translates to a comp of positive 4 to 8% for the holiday quarter.
And the margin story continues. They expect another 300 to 350 basis points of product margin expansion in Q4.
Which is why the guided Q4 net loss is so much smaller. Only 3.5 to 5.5 million versus a huge loss last year. They are getting very close to break even fast.
And we should mention the store closures. They're strategically shrinking the footprint, closing unprofitable stores to get stronger.
But here's the statistic that, for me, just defines this whole turnaround: the power of operating leverage. In Q3, their store teams delivered positive comps while using 7% fewer hours on average.
That's a massive productivity gain.
It's huge. It means if they keep growing comps on fewer hours, every new dollar of sales becomes exponentially more profitable. That's the engine that can drive a stock like this much faster than people expect.
And that explains the price action. Trading volumes spiking over 20 times the average, that's short covering. That's the market admitting the turnaround is real.
Which brings us to the big question for investors. How do you play this now? The stock's already run 40%, but it's still in the low single digits.
Right, it's a classic turnaround play, not a growth story, which can be tricky, but the execution is so clean. So my pitch to the investment committee, and remember, this is not financial advice, just educational analysis, is a structural trade on this operational efficiency.
Okay, walk us through it, the long leverage play.
The idea is simple. You establish a long position now with a tight stop below the recent trading floor. You're not betting on massive growth. You're betting on margin recovery and that operating leverage we just talked about. The target is a multi-year price range, maybe $4 to $5, where the stock was before the big decline.
That seems like a pretty outrageous target from here.
Yeah.
What's the catalyst that gets it there so fast?
The outrageous but plausible part is the short squeeze. The company has a big accumulated deficit, sure, but if they just deliver on their Q4 guidance and string together another good quarter after that, that deficit shrinks fast. The combination of positive comps on fewer store hours is the fuel. And on a heavily shorted stock, that can create a violent squeeze that takes the stock back to the mid-single digits way faster than the fundamentals might suggest.
So it's a high-risk, high-reward bet that management can keep executing. It's based on proven efficiency, but you're betting that efficiency continues. Definitely one to analyze.
We've covered a really remarkable quarter for Tilly's, a return to positive comps, huge margin expansion from inventory discipline, and that strategic shift online. The challenge now is maintaining this momentum.
Exactly. They have to deliver on that strong Q4 guidance, and they have to make sure these AI and proprietary brand initiatives actually stabilize the top line for the long run.
The core thesis here, discipline on inventory, margins, and expenses, it's clearly working. But here's something for you to mull over. Can a focus on efficiency and their own brands be enough to sustain positive comps in this crazy competitive apparel space? Or will they eventually need to reinvest in third-party brands to shift the story from just a turnaround to real sustainable growth?
Thank you for joining us for this deep dive into the TLYS earnings call. We encourage you to analyze the power of that underlying operational leverage for yourself.